Everybody, Robert Bonavito, New Jersey forensic accountant. Today we're going to talk about crypto fraud. And our firm has a lot of cases on crypto fraud. I'm going to talk about one specific case within our firm that we just did. And it had to do with about $41 million of missing funds. Now, people have to understand that when you have like Goldman Sachs and you give them money, right, and they trade it for you, you can actually see what's going on, and maybe they might not make you money, but they're trading on the New York Stock Exchange or they're trading on the NASDAQ, and it's pretty secure. But with crypto, now this company here, they were going to trade crypto, and they were going to trade on a crypto exchange like Binance or one of those. And so people gave them money, and they were going to trade and make millions and millions of dollars, but the money disappeared. People were putting money into crypto accounts called wallets, and we're going to go into that, and they were disappearing. And we were able to actually trace it and lock it up. But the big problem with crypto, especially the crypto trading firms, is that you have to be where the partners within the firms are the thieves. That's kind of like you putting your money in Morgan Stanley and the Morgan Stanley partner stealing your money. That's what's actually happening. So you give them $30 million, they're stealing the money. Or maybe the crypto exchange is stealing money, like Binance or one of the other ones. For example, so if I give my money to Goldman Sachs, I have to worry about the partners steal. It doesn't happen, right? They don't steal the money anymore. It's very rare. And then they invest it in the New York Stock Exchange. It's pretty safe there. But let's assume that both of those are stealing money from me. Right? How would you defend it? And that's what happens with crypto. Your partners are stealing, and the exchanges are stealing money. And that's why we have so much. And the big thing is the myth of security. And what do people say? Well, the blockchain's 100% secure. Well, obviously we do trade, we're able to find this money, so it does work in some respects, but we're going to go through how these people tried to hide it. And crypto scams are going through the roofs. And if you just look at one of the organizations that tracks crypto crime, and we always use this chain analysis, this crypto crime report. And what's interesting is they classify all the fraud, like right here, you could see what kind of fraud. And when you talk about crypto, there's tons of fraud, right? Ransomware, online pharmacies, stolen funds, scams, creepy stuff like child abuse stuff, all kinds of, fraud with crypto. And here's our part. We usually do with scams. And that's really growing a lot. But look at ransomware, how it's, this right here, this green, it's actually declining. This is 2024, but it's about $51 billion is missing. And anybody who wants to get involved in one of these trading firms, I would say, listen, I said, the people who are going to steal money from you is your partners and the exchanges. Good luck. Good luck. And that's kind of like Morgan Stanley and the New York Stock Exchange stealing money from you. Like I said, it just doesn't happen. And so here, obviously, the big problem was they trusted their partners, and these partners were Russian. They were from Russia. It's like, so, I mean, they should have, there was a lot of problems with the whole investment. And the thing is too, with crypto, one little click of the mouse and I can move hundreds of millions of dollars. Obviously blockchain's tracking it, but I can do that. You can do the same thing with the New York Stock Exchange, but they're regulated. It just doesn't happen where money is stolen. So here's just a little bit of background. Again, you guys could go through this if you don't understand this. But, what is a crypto exchange? And remember, this crypto corp was going to be trading on a crypto exchange, Binance, Kraken, HTX. And what they do is you give them $100 million, they trade it, and they tell you you're going to make, $1 billion. So you're going to, your money's going to go up by 10 times, 10x. And, so think of these Binance and as the New York Stock Exchange, right? And there's two types what they call wallets. There's a checking and a savings account. So there's two types of wallets, right? You have one that's connected to the internet and where all the trading is. So if I was to give Crypto Corp $50 million, I would put it in one of the wallets, and then they would go to one of these exchanges and trade it. Now, there's another one called cold. It's a cold wallet. This one is not. This is offline. This is more secure. Nothing's secure in crypto, but you could put money there, and it's a lot harder for people to get into it. This year, the checking account, there's a lot of problems that can happen, and that's where the money was actually taken from. And what kind of assets? Well, there's all kinds of crypto, right? But these assets in this firm were basically Bitcoin and stablecoin. So this is the backup here to this case we had. And what happened was the partners in the Crypto Corp set up a fake wallet. Okay, so let's say I have a wallet here and it's called Durbit QL. And they say, hey, put it in this wallet. So I transfer $50 million to this wallet here. And then they take the wallet and they start trading it, right? They go to, Binance or and they're trading it and they're making all kinds of money. But what happened was someone in the firm changed the name. And so when I put the money in that wallet, it disappeared through a trapdoor, right? And it went to, so there was an instruction saying, you send money to this wallet and then we'll trade it. But it didn't go there. And what they did was they started to skim it. They did something called a peel chain technique, and they moved the money all over the place. And here's some of the techniques they to cover it up. They what's called a loopback. Okay. They also from one wallet to another wallet, and they did this in small increments. They didn't even know they lost the money. It took them like 6 months to figure it out. There's a mixer and tumblers technique that a lot of them use, and they used it here, and layering. And this is what we showed the court when we testified in court. We showed them this is how they did it in the hidden wallets and the peel chain and all the loopbacks. And there was a lot more detail, but this is what they did to hide the money. It went through their trapdoor. They hid the money, and it's very hard to trace. But there is, blockchain does work somewhat. So, how we discovered it and we caught them. Okay, we were able to trace the money to a cold wallet. And in the cold wallet, now remember, you have the one regular wallet where they're trading in the cold wallet. So what they did was they used all these techniques to hide the money. They skimmed it. We traced it to a cold wallet. The money's sitting there. We know where it is. We have it isolated at this point. So this was a big win. It's very difficult to do. We did it. We have some techniques that work. We found that there was a lot of problems internally, and we actually linked it to one of the owners of, the investment partners at this point. And, so the conclusion is, the victim fell to a breach of trust. Okay. And because of blockchain, they couldn't hide the, crime forever. Now while cold storage is secure for the thief, it also preserves the evidence. Now, this case, we're still trying to get the money back, but at least we know where it is. So this is, hopefully you guys learned something from this case. And if you have any questions, email me. I can go through some details or whatever you want. Thanks a lot for listening, guys. Hey, by the way, smack the like button if you do like this.